Let me ask you something uncomfortable. If your income is uncommon, if your balance sheet is complex, if your tax exposure is massive, why does your portfolio look exactly like everyone else's? The truth is, for high net worth investors, that similarity can cost millions, not because markets don't grow, but because structure matters more than selection. I'm David Harris from Alternative Investment Advisors, and welcome back to Investing Outside the Box, where we redefine how wealth is structured, challenge conventional thinking, and guide high net worth investors toward portfolios that are steadier, more tax aware, and designed to reduce unnecessary volatility. If you've built real wealth, you know something most investors don't. More money doesn't reduce complexity, it multiplies it. You have concentrated stock positions, business equity tied to one industry, real estate leverage, seven-figure income taxed at top marginal brackets. That means your financial life is already exposed to specific economic drivers, growth cycles, interest rates, credit markets, regulatory shifts. A traditional 60-40 stock and bond portfolio was designed for retirement savers accumulating diversified exposure. It assumes earned income is separate from portfolio risk, but for affluent investors, that assumption is often false. That mismatch is where frustration begins. This isn't about beating the market. It's about building a financial structure that actually fits your life. There's something successful people rarely admit. Wealth creates pressure. Pressure to preserve, pressure to optimize, pressure to not make the wrong move. As your net worth grows, so does your exposure to sequence risk. The danger that major market declines occur when large capital pools are deployed or needed. Large portfolios magnify volatility in absolute dollars. A 15% correction on a $10 million portfolio isn't theoretical. It's $1.5 million. And here's the structural issue. When markets drop, your investments drop. When your industry slows, your business equity drops. When credit tightens, real estate valuations adjust. Everything responds to the same macro forces: liquidity, growth expectations, and interest rates. That's not diversification, that's correlation. True diversification isn't just owning more securities, it's owning assets influenced by different economic drivers. When risk sources are duplicated, volatility feels personal because it touches every line of your balance sheet at once. The market is one economic engine, but it's not the only one. Legal systems function independently of quarterly earnings. Litigation finance outcomes depend on case merit and legal process, not the S&P 500. Infrastructure assets generate revenue through long-term contracts, tolls, utilities, and essential services, often indexed to inflation. Private equity builds value through operational improvement before public valuation ever enters the picture. And the tax code, regardless of headlines, continues to reward certain capital behaviors. When all your assets depend on public markets, your financial life becomes emotionally reactive. Alternative strategies aren't designed to eliminate risk. They're designed to introduce non-correlation, meaning their returns are not primarily tied to stock market direction. Different drivers, different timelines, different outcomes. I worked with a tech founder whose wealth was deeply tied to his industry. Every earnings cycle felt like turbulence. He had concentrated equity exposure, venture investments, a portfolio heavily weighted toward growth stocks. From a correlation standpoint, nearly everything responded to the same economic narrative. We carved out a portion of his portfolio: litigation finance, private equity, infrastructure exposure. These weren't speculative bets. They were assets driven by contractual cash flow, legal outcomes, operational improvements, long-duration capital projects. Months later, tech stocks dropped sharply. His equity moved, but his alternative sleeve did not mirror that decline. He told me something simple: for the first time, I don't feel like my entire future swings with a headline. That's the shift. Alternatives aren't about chasing exotic returns. They're about reducing portfolio correlation and emotional volatility. Then there's taxes. For high earners, the biggest drag isn't volatility, it's taxation. At higher income brackets, marginal tax rates can approach or exceed 40% federally before state taxes. That means a 10% portfolio return doesn't compound at 10%. After taxes, it may compound closer to 6%. Over decades, that difference can represent millions. Certain alternative strategies provide structural tax characteristics: depreciation benefits in real asset investments, capital gain deferral, long-term capital treatment, loss harvesting flexibility, cash flow distributions with favorable tax positioning. They aren't loopholes, they're incentives embedded within the tax code. When tax drag decreases, net compounding increases, and small structural improvements compound exponentially. A portfolio that blends traditional exposure with intentional alternatives behaves differently. It still participates in growth, but it's not dependent on a single engine. It combines liquid public exposure, contract-based private income, inflation-sensitive assets, and tax-aware structures. It feels different because performance isn't synchronized. Volatility becomes segmented instead of systemic. Tax planning becomes proactive instead of reactive. Concentration risk becomes intentional instead of accidental. It's not radical, it's simply aligned, and alignment changes everything. If today's conversation resonated, it's probably because you felt that quiet mismatch. Success on paper, but unnecessary structural vulnerability underneath. My work focuses on helping high net worth investors design the alternative portion of their portfolio, the part that introduces independence, tax efficiency, and structural balance. This doesn't replace traditional investing, it complements it, strategically, proportionally, and intentionally. This isn't for everyone, but if your financial life is complex, and you're ready for a structure that reflects that complexity, let's have a conversation. No obligation, no generic proposals, just clarity. You've built something extraordinary. The question is your portfolio engineered to protect it? Click the link below to book a call to get the ball rolling. I'm David Harris, and I'll see you next week on Investing Outside the Box.